Hey there, Jeff Lewis with Epic Trust Investment Advisors coming to you in the first part of the second quarter of the year. Today we're going to do a market review of the first quarter. We're going to go into what has happened for the last quarter and some of the big takeaways from last quarter and how things are moving along. So with that, we'll jump right into it. All right, so the first quarter review, we've got a couple of big takeaways that I really want to drive home to you guys. And with this quarterly market review, we're actually going to have a whole lot more information below the video in our blog post. And so if you are watching this video on Facebook or you're watching it on YouTube, that's great, but be sure and go over to epictrust.com/blog and find this blog post so that you can read the rest of the technical information. So we've got a lot of information that's going to be there in text format. This video is really just going to be a high-level view of what happened for this last quarter. But if you want to get into more of the details and the numbers and the technical side of things for what happened this last quarter, I would love for you to go to the website and you will find a lot of information there that is going to be a lot more informative than what we're going to be able to have time to cover here in this video. So if you're that kind of person, you want the technical stuff, great, I love that. We thrive on that stuff, and so we've put that into the text below the video. What we've got, high level, I'm gonna hit about 5 or 6 different points, and then I'm gonna leave the rest up to the text. So for the most part, we had the markets recover really the majority of all the losses that we saw since September of last year all the way to December of last year. That last quarter of the year, last 4 months, 3.5 to 4 months of the year, we saw the S&P 500 and the Dow Jones at its peak levels for last year, and that's where it really dropped. And so December, we hit our bottom. Since that point, we've seen almost all markets recover the majority of their losses, and in some cases, all of their losses, and they're now into gaining territory, hitting new highs again. So that's really exciting to see. We talked about that in a prior blog post. If you go back to our December 22nd blog post, you'll see the past recessions and the past corrections that we've had in the market and the amount of time that it's taken to go through the correction and hit the bottom to the time that it took to recover from that correction. And what we've seen is that this correction, just like I predicted back then, has followed exactly the same path. That we had about a 3-month drawdown, and we've seen in 3, now almost 4 months, or a little over that 3-month time frame, we're seeing that pick back up and the market's recovered, and now we're back making new highs. And in some cases, we're almost there. Other cases, we have already made that point. So that's really exciting news. It's doing what the market, or at least the market is doing what I predicted would happen earlier on in December. And so it's always nice to be right. And in this case, we're both right if you stayed in and you kept invested the way that we recommended you to be. So good job if you stuck with it. I applaud you. You're a great investor. You got to stick to your guns. We've got to stick to our guns in those scenarios. And if you did, it's paid off well for you. So that's awesome news. Probably the best news of today is that the money that was in your account in September, as long as you stuck with it, it's back in your account today, and you should be doing very well as far as your investment returns go for the first part of this quarter. So next update, U.S. China trade talks are also going well. This is really good news. I love to see that we're making progress on this front, and so we're not out of the woods yet. That's the big takeaway that I want to deliver for you today, is that we are making great progress, really great progress. And especially this last week, we've heard some new good things coming out of the China trade talks. I know President Trump really wants to get this done quickly, especially before the election comes along, just because this is a big part of what his presidency is all about. But more importantly than politics, this has nothing to do with politics, as at least this next statement doesn't have anything to do with politics. From a pure economic standpoint, this trade negotiation and the deal that comes from it is good for America, it's good for China, and it's good for the rest of the world. With us being able to protect our intellectual property and the things that are coming out of this trade conversation and this trade negotiation, it will be good for all of us involved. And so I'm looking forward to seeing this come along. One other positive thing about this coming to a resolution is that we're going to be able to experience better returns in the international market. If you've been following us for a while, you know that last fall we actually got out of international markets completely, all our emerging markets and all our international developed international markets we've been out of for quite some time, and that has proved to be the right decision as well, just because these elements that we're seeing in the international and global economy, where we're seeing a weakening economy, I still see that coming in the future months and not being able to get through to a recovery point. So while international markets prices have recovered along with the rest of the U.S. markets, it still hasn't recovered as well. And so relative to U.S. markets, U.S. is still a better place to be invested than internationally and in emerging markets for the most part. So that's just a general rule of thumb. I can't say that definitively because obviously someone's going to be able to go out there and say, hey, Jeff, there's this really great place to be in India, or here's a couple of great stocks in Mexico. In fact, my own grandmother says to me a couple of weeks ago, she told me I should invest in the Amazon of Mexico, and she has, and she's made some great returns with that stock. But that's one example, not the global example of a great place to be invested. So for now, we're still going to be staying out of international stuff and emerging market stuff. If you go back into it now, you probably could do very well as these trade talks and Brexit gets resolved and the rest of the global economy continues to find its footing and get back on more solid ground fundamentally. Then we're going to begin to see a rapid recovery in international markets. And that will be a great place to be invested when that time comes. We're still holding off on it, but if you're a little bit more aggressive or you'd like to gamble just a little bit more, go ahead and put some of your new contributions into the international space, and you probably will come out well in that scenario. However, if China trade talks continue longer than we'd like them to, longer than the next 3 or 6 months, and we don't have a deal, and Brexit continues to get drug out, and the rest of the global economy continues to suffer from that uncertainty, you're going to probably not see the kind of returns that you'd like to see had you been in the U.S. markets, or that you might be able to see from U.S. markets. So that's just a heads up on that. That's where we are with international stuff. We're continuing to stay out of international emerging markets. But if you're aggressive and you want to continue to be aggressive and you want to get on the front side of that upside curve, you could be an early adopter and go for it. Next point for this last quarter, the Federal Reserve pauses in 2019. Late January, Jerome Powell, our Federal Reserve Chairman, definitively said, we are not expecting to make any more rate hikes for the rest of 2019. That was a huge signal for the markets and has helped to continue to bolster the recovery that we've seen over the last 3 months. It wasn't the thing that started it, but it's definitely helped to continue the recovery. That move was expected by the Federal Reserve before they announced it. And so when they announced it, it didn't actually have as big of an impact as most people would have expected it to, because it was already actually priced into the market. So we didn't see a huge bump from it, but it's definitely continued to add support to this recovery. So that happened January, February, and we're seeing them stick to their guns on that. Now, the issue with the Federal Reserve pause is that if we get unemployment rates that come way down and we see some really high employment numbers and really high wage growth over the next several quarters, that's going to put pressure on the Federal Reserve to say, hey, wait a second, we might do this later on. So there is some caution in what I'm saying here with the Federal Reserve on their pause, even though they definitively said they want to pause for the rest of the year. If we get some data that pushes them to a point where they may not, they will make that change, in my opinion. And the Reserve Chairman that we have now has made he hasn't been shy about making changes to policy when that policy warrants the change. So just a heads up, right now, we're not expecting future rate hikes this year. But if our wage data and employment or earnings data for individuals, our take-home pay, if that grows is at too high of a rate, they may start looking at that. However, for now, we're not seeing that, and that's a good thing for markets. Next one, corporate earnings are back on the rise. This is good news as well. So last quarter, the fourth quarter of 2018, and as well, partially for the third quarter of 2018, we didn't see a reduction of earnings, where earnings were going backwards for companies. But what we saw was that earnings for companies weren't as high as they were expected to be. So while they were still positive, they weren't at the same positive percentage rate that analysts were expecting them to be. So that caused some real pressure in beginning in the third quarter and really driving the nail through the coffin in the fourth quarter of last year. And that was a big catalyst for the drop that we saw in October and December of last year. Now, on the flip side of that, though, what happened in first quarter of 2019? We've seen those corporate profits stabilize, and we've seen them begin to improve with some companies. And what we're seeing from some preliminary data for the second quarter, we're beginning to get some good vibes from the companies that are going to be reporting pretty early. So that is really positive news. That's going to actually be a required part of our continued growth for this market, for where we are right now, because we're beginning to set new highs in some parts of the market, like small caps and mid caps, specifically in the growth sectors or the growth portions of those markets. So if we're going to see continued rise from here, we need corporate profits to continue to rise, and to continue to rise at the rate that at an increased rate. So as long as we do see that this quarter, like we saw in the first quarter, then we're going to see this market likely continue to keep going in the direction that we've been going this year, which is awesome news. So next up, international markets are still struggling. It's not just Brexit that's causing international markets. Germany has struggled a little bit this year and last quarter of last year, or the fourth quarter of last year. Italy has still been struggling, although they're working through their issues. You can go back to a prior video and learn a little bit more about Italy's issues that they've been having, but they're working through them. And we've got other countries around the world that are still struggling a little bit with their economies. And so while I've got Brexit here, there's other countries as well that are still struggling. So this is another reason why we're not investing a lot internationally, because we're just seeing too soft of fundamental data. Now, that being said, the charts that we're beginning to look at, or that we have been looking at and we follow, just so you know, we follow both fundamental data, which is things like earnings and reports from the companies or countries that we're following, and data that we're getting from the Federal Reserve. But so that's fundamental data. And the other side of that coin is the technical data, the chart data that we're looking at. If you look at a stock chart or something like that, that's technical data. And so what we're beginning to see from the technical data is we're seeing a pretty nice rebound in international markets, but it's because they got hit so hard last year, much harder than the U.S. market did. So they've been able to recover a little bit more quickly, but it doesn't mean that they actually have the economic data to support it. It's just that there's buyers back in the market. And so again, if you're an aggressive investor and you want to go international, you can. You're probably going to be well served for that. That's a guess at this point. I can't say that with a lot of confidence yet, just because we have too many unknowns, like Brexit and the China trade war and other economic struggles that are global. And when we see those economies begin to get their footing and move back into positive territory, it's going to be a great place to be invested. So next up, we've got the yield curves. So while some yield curves, you've probably heard a little bit about this on the news, and we've been talking to our clients about this pretty regularly over the last couple of years. But the yield curve is a pretty important early recession indicator. And so while the news has talked about, and specifically if you've been watching Bloomberg, I've seen quite a few episodes or quite a few news stories covered on Bloomberg early in the morning about the yield curves. They're talking about really short-term yield curves, so like the 2 and the 5-year yield curve. And really what this is just the difference between a 2-year loan or a 2-year treasury note and a 5-year treasury note, or a 2-year treasury note and a 10-year treasury note. And normally what we want to see is that we want to see there be a pretty wide margin of difference between those two loans. Specifically, the longer term loan, we want to be more expensive than the shorter term loan. Just like you would expect a 30-year mortgage to be more expensive than a 15-year mortgage. We're expecting that same relationship with the yield curve when it comes to treasuries. But what we see is that when we see those yield curves flatten and then become, it should be this way, right? So as we see those yield curves flatten and then become inverted, that's a warning sign for the economy, because it means that those companies and those economies or countries that use short-term borrowing to fund operations or whatever they do with their short-term money, we don't have time to go into that today in this video, but those companies or countries or banks that use short-term money to fund operations or to provide loans to borrowers, if it costs them more money to give that than they can get from their borrowers or from a longer term loan, that makes it more expensive for them to operate businesses, and that slows their business down. But because it takes so long to work that loan through the pipeline or those interest rates through the rest of the economy, it just takes time for those things to develop. So because of that, this is an early warning sign for an economy or for an economic recession. And what we need to be looking for is that when this yield curve does invert, the 2 to 10-year yield curve, which if you look at this slide, we're not there yet. We still have positive 18 basis points as of last Friday. So that's good news because we haven't inverted yet. And once we invert, we've got to invert for more than about 3 months for this inversion to be a pretty solid inversion, and stick with it. And then from that point forward, we've got about a year to 18 months before the recession actually hits, which means typically the stock market is going to hold up really pretty well still during that time frame. It doesn't always happen that way, but it usually does. 4 out of 5 times, the stock market continues to rise after the yield curve inverts until we hit that recessionary time frame. So the reason that's important to know is that we've still got, at least from today, I'd expect at least a year, 18 months, maybe even 2 years before the next recession hits. That means real estate markets are probably still going to be good. Interest rates for mortgages are probably still going to be good for a little while longer. And the stock market is going to provide good returns still for a little while longer. So really quickly, we're going to run through a review of all those key points that we hit. Most areas of the stocks, bonds, and commodities markets have recovered from the fourth quarter of 2018 decline. That's great news. We're in good shape there, and I expect that we'll continue to move in positive territory for the foreseeable future. Next up, we've got U.S. China trade negotiations are progressing nicely, but until the deal is signed, we're not out of the woods. The Federal Reserve's officially pushed the pause button on interest rates, and for at least the rest of 2019, and we'll see where they go for 2020. Next up, corporate earnings, one of our primary drivers of the stock market, have improved compared to the fourth quarter of last year, and they need to continue to improve for the market to continue to rise much further from where we are today. We are really, from an earnings multiple standpoint, we're at the high point of where the market is today, which is awesome, because in January and late December, we were at the low end of the scale. Now we're at the high end of the scale, and we need corporate earnings to continue to grow for us to continue to push this market higher. Next up, we've got the international and global markets outside of the U.S. are still fundamentally struggling, but the technical indicators, like we talked about before, the charts that we're looking at, are pointing towards major improvements, but not total security yet. So still a tough place to invest. If you're aggressive, go ahead and gamble a little bit there. And it's not really a gamble, but you could probably put some money in the international markets and you're going to be served well, as long as China and Brexit get our stuff together and the rest of the international markets continue to improve. So last up, some areas of the yield curve have inverted, although in my opinion, the most important one, the 2 versus the 10-year yield curve, has not inverted yet. And when it does, we'll let you know so that you can be prepared for that year to 18 months down the road. And we'll be able to talk about some of the precautions that we're taking for our investors that we invest money for, on what to do to actually implement some protection in their portfolio. So even after the 2 and 10-year yield curve inverts, I already talked about that. We've got 12 to 18 months before the recession hits. So last up, risks do remain in the market. Be cautious, but it's okay to be optimistic for continued returns from this point forward, assuming that we don't have any big upsets in corporate earnings with this next earnings cycle that comes through. So this next month's going to be a big month. I'm excited to go through it, and I'm excited for you guys. This is a great time to be invested in the market. And I hope you guys stuck with it. And if you did, congratulations to you. You were proved right, and you're well rewarded, or should have been well rewarded, for sticking with it and to staying invested. So keep on your long-term plans until major changes happen where we get to that recessionary time frame. We're not going to be making any really major changes in our portfolios, even though we did do some rebalancing this last month at the beginning of April with our portfolios. And our investors, you should have seen some trade notifications coming through from TD Ameritrade with the rebalances that we made in the portfolios. We did change a couple of things, but it wasn't anything terribly major. We're just trying to go for some of the we're trying to invest in some of the parts of the market that are showing relative strength versus relative weakness. So we've moved out of a couple areas, or at least reduced our exposure to like SLYG, which is one of the small cap growth company stocks that or ETFs that we work with. And we've put a little bit more towards mid caps and our other small cap growth fund. Anyway, you've probably seen those if you're investing with us, but things are going really well. I'm really happy with the performance of the portfolios for this year so far. And the recap for our first quarter, couldn't have been happier with the recovery that we've seen and experienced over the last 3 months. So with that, in the next week and a half or so, we should be getting our next monthly update on our recession probability breaker panel. So as that comes along, we'll share that with you. And so keep your eyes out for the next video. So let me know what you think of the video. Give us a subscribe on Facebook or on Google or YouTube, and let us know what you think in the comments below. And if you're a technical guy, remember too, or gal, you can read the comments below. We've got a more technical write-up of this quarterly market review for you down below this video. So thanks a lot. We'll talk to you soon. We appreciate you guys. We love you. And thank you for trusting us to help you with your finances and your future. It's not a responsibility that we take lightly. And I just feel honored and blessed to be able to have you guys in my life. Thanks so much. We'll talk to you soon. Bye.